Live.
All right, guys. Jody Humphrey and Kimberly Odie here, ready to rock and roll for today. I believe Tim's on a call that's going on right now with Corebridge. Um, if you're there, Tim, make some noise, but I think he's there. Also, we are just having this in Spanish if you need it on the normal channel. We got several things to go over today, so we're very excited to have all of you here. I've got some good information to share with you. First of all, let's get right into the information that you need to know as far as updates, great things that are happening. Um, I want all of you first and foremost to write out whatever your goals were for this this month, and I want you to go do them over the next week. That's what I want to see from all of you guys. So I think we've got a great program lined up for you today. Hopefully, it'll help you really go through and get prepared. Hopefully you can see this little note I got prepared for you. It will help you as far as calendaring goes. So let's talk about some up things. And if your calendar will reflect where you're headed, by the way. If you want to know if you're headed toward your goals, look at what you're doing. And at some point, for you to be successful, you're going to have to go and create where your habits align with your words. If you write that down, at some point, your habits and your work ethic has to align with your words and your goals. Because if they don't, you're never going to be successful. So let's take a look at what we have as a team lined up. This is just for the next 30 days or thereabouts. Okay. Actually, it is for the next 30 days. So got some great things lined up. First of all, this upcoming Monday, August the 25th, I will be in Tampa, Florida, and we will be having one-on-ones and also a bop that night. So if you are interested in having someone in that area, let me know. But we'll be getting you a little more information on this event. But it's about 5 minutes from the airport, and it's going to be awesome. So at 6:30 that night, we'll be having a bop. So if you have people in that area, let me know. I know that Gail does. I know that Debbie does. I know that Peter and Mauricio have a strong team there. So I'm excited to go there, spend the day there. Tuesday next week on August the 26th, I will be in Orlando. We'll be having a bop that night. It's looking to be pretty powerful. I'm very excited about it. And it's going to be Sylvia and Francisco are helping me host that. And we're going to have a great meeting with people from all over. So I think we'll have a packed house that night. And then Friday next week, August the 29th, I will be in Denver. I'll be doing a bop that night with Unai's team. So excited for that. That's part of Herfin's and Rafa Garcia's great organization. And then the following day, I'll be doing training there in Denver. So if you have people in Denver, and guys, even if you hadn't thought about it, go search your list, see who you might have in Denver, because where you go, you grow. You hear that every week if you happen to listen to Leadership Live. That's Aki's mantra. All right. Then we'll have a meeting on Thursday in Houston. I'm sorry. So I'll be in Denver on that Saturday. Then the following week on Tuesday, September the 2nd, I will be in Austin, Texas. We'll be having a great BOE there and one-on-one trainings. The next day I'll be in Dallas, and this is going to be a power pack 24 hours because we have so many great things happening right now in Dallas. I got some great base shop things happening. Giovanni's got a great new guy there. Obviously, we have Erica and Joanna and that great team there. Plus, we got Cardenas and Adolfo that are building great there. So if you have people in Dallas, get me in front of them that day. And then I'm sorry, Austin the second, Dallas the third, and then Houston the fourth. And I'm very excited about going there for the Texas takeover. But we're really excited to announce the next thing for you. And that's the week of September the 16th through the 18th. We're doing the Atlanta Takeover, Bigger and Better 2.0. The guys were really excited to announce it the first night, Tuesday, September 16th. We're having what's called an economic summit. And you imagine that you can go invite people from all over the Atlanta area to come hear the most power packed, diverse, 2 hours of how money works. Anybody, the people used to have to pay thousands of dollars to go get a course for any of this stuff. We're going to go have it all in one place. We're going to have land banking. We're going to have annuity powerhouse training. We're going to have, insurance and why how to be your own bank. We're going to also have money under management. We're going to also have estate planning all under one umbrella. That's going to be phenomenal. We're going to have Matt Salvatore there. We're going to have the Brian Speranoff there and others. It is going to be awesome. So that's going to be Tuesday, Rose, September 16th at the Buckhead Club. So we need to get all the new people there. We're going to lead. Here we're going to be leading with the product to get to recruiting. Then on Wednesday, day 2 of the Economic Summit, it's going to be up at Steve Gross's office, which is in the Marietta Vinings area, and then at the home office on the 18th, on that Thursday night to finish it up. And well, I'm so excited. So the growth is good. I fully believe we could double our team by doing this and then doing it again. And guys, I'm not even going to show you what the rest of September and October looks like. It's the same. And then again, it's the same. So go make it happen. Use all these resources we're going to have. You got people in these areas. Go look on your social media, see who you got following you in these areas. Be bold, get them to this event. So you'll be getting information. Hopefully you took a snapshot of this. And we're so excited about this great event. So that's going to be fantastic. So now then, let's get over here and talk about, hold on a second there. You don't want to see my upper view of me. But let's go back and talk about what today's subject matter is. And I'm really excited about it. We're going to talk a little bit about, in my Macon, Georgia terms, on how the industry that we know of as the life insurance industry has evolved and how it's gotten to where it's at. And I'm just going to hit you with layman's terms on how big of a deal it really is. And I went over this last night and had a great, I thought, rave reviews, and I'm going to do it again, but I'm going to really consolidate what took me 45 minutes last night to about 15 minutes today. And then I'm going to turn it over to Kimberly, who has some tremendous things lined up for you on some great new applications of the products that we have. Now, first of all, we were both fortunate to be able to win the contest at Corebridge had. And so also I want to congratulate the great leaders that we have on the F&G contest. They have 18 slots and our team won 15 of them. So real proud of you guys for having won that contest. And I'll be announcing who those winners are next week, but so proud of you guys for doing such a great job with those guys. But congratulations to Zach and Kimberly. They were number 5, I believe, in that Corebridge contest. They did a great job, but it was a great event. And I want you to understand the enormity of how big this organization really is. If you just took our product providers, and these aren't product providers, these are partners. You go look at Corebridge, you go look at North American, which is part of the Salmons Group, which is one of the largest privately held companies in the United States. And then you go look at Nationwide, just those 3. You're talking about 3 of the biggest companies of any kind in the United States. And I want you to think about this. They just announced, and I think Kimberly will show you this in a minute, that they had $1 trillion of business that they put into force. And I want you to get your head around this. $1 trillion worth of business. Was that the face amount that they have had in force, Kimberly, do you know? But it's $1 trillion
in-force life insurance face amount.
Now listen, they have $1 trillion of in-force life insurance face amounts. The enormity of that, I don't even know how to put it into context. We can't even comprehend millions and billions. But listen, within a company that has one of the top name recognitions in the world on the AIG side of it, we're the biggest independent distribution system channel that they have. I want you to think about that. That's crazy. And that's true with Salmons, which is North American, which is as big. And then, of course, Nationwide, which I think is even bigger, is we are the fastest growing distribution channel they've ever had. So that's what we're about. That's who we are. And that's something I'm so proud of as you look at that, okay? Now, also, I want to walk through for a few minutes some history. And I think this will be great for you. So I'm going to switch over to to my iPad. So bear with me for just a second. So you won't be able to see me for a few minutes. You'll just be able to see what we're going to be showing here. But I think you're going to really enjoy this as we walk through this. Okay. So I'm going to talk about how the industry has evolved and how incredible that this really that we have what we have to offer really is. Okay. And I want you to understand the power of what we have when we're seeing people, the power of being able to go out and to really literally to be able to sit down with families and provide them with the best products in the industry. Okay, so let's talk a little bit of history as we go through. And if you have any questions along the way, you know, let me know. And I think that most of it will help you as we walk through this. Okay. Now, there's two issues that everybody faces when we're talking to them. And I thought Mauricio said this last night as succinctly and as powerfully as I've ever heard it said. Because he said, you know, he was reflective and he says, you know, what's the power of life insurance? What's the purpose of life insurance? Well, it's to guard against to guard against dying too soon. That is the very definition of of being able of what life insurance is. Or if you go through and ask what's the purpose of an annuity, it's to guard against living too long. That's the two purposes of what those products are. So let's go through and I got some of these drawing on here. So let me go back here and erase this. We started writing it, and you got people writing on there. So here we go. So let's talk about some things that I think are going to be kind of exciting for you, especially for those of you that are newer to the business. Okay. If you go back and you look at basically 1980 and previous to 1980, so let me write down 1980 here. So pardon me for my lack of being able to write very well at this point, but it will get better in a second whenever the vehicle I'm in stops moving. But in 1980, if you most of you don't know what America's financial situation was like previous to that. If you had to talk about the average family previous to 1980, all they counted on the three-legged stool that Zach talks about in his unqualified me presentation. And it's but if you go back previous to 1980, most all American families were counting on a pension. They had their savings in the bank. They had their Social Security that they were counting on, and they all owned whole life insurance. Okay, that is pretty much what you had. Everyone, that was their scenario. Because what group of people was this focused on? It was the senior market. It's the group previous to the baby boomers. They were all very much a status quo group. Okay, they were the ones who just did what everyone else did. So that was a snapshot of pre 1980, what everything looked like. Okay. So now then, what happened? What was the reasons for that? It was all about security and it worked. Okay. You had low inflation, stock market really hadn't emerged. But what happened was the reason people bought whole life and whole life insurance, which some of you know the term permanent life insurance, right? The reason that whole life policies were successful or popular during that time was that they were looked at as a forced savings event. Now, what is a forced savings? That a forced means you have to put money away. And I'm going to tell you, if you look over here and you're always talking about how to overcome human nature, you got to realize human nature is a funny thing. Human nature is people don't save money. Human nature is people put things off and they put things off, right? And so what happened was within a whole life policy, you had one check. And what that meant was when you wrote your premium, it was one check. It was, let's just say you were spending $200 a month, okay? And for that $200 a month, the life insurance company took part of that money and they bought you death benefit. That was how much you got when you died, whatever was the face amount of your life insurance, right? But the rest of that money would go over into the cash value of a policy. But it only did about 1 to 3% rate of return, but it was sold on the fact that you saved money on a forced basis. But also, imagine an electric fence that was around this savings account, that it created a tax favored status where basically your money could grow in that account tax free. Well, it wasn't that big of a deal because it was only growing at 1, 2, 3%. But that tax free status becomes the foundation of this whole story. Okay, because why was it tax free? Well, basically, if you go back and you look at the late 1920s, 1928, 29, you had the stock market crash, right? And so during that stock market crash, at that time there was a great run on banks, as you'll remember, right? It was on the Great Depression started during that time. There was a stock market crash. There was a run on banks. So what industry did not go under during those times? What industry thrived? It was the life insurance companies. And the reason was because their contracts were structured so that you could not have a run on them like there was a great run on the bank. If you don't know what a run on the bank means, is that everyone ran in, literally, people running in to take their money out of the banks, and that's why they collapsed. But the U.S. government, created an arrangement with the life insurance industry to help them the banks and the American economy. And because of that, they created a relationship that was symbiotic for both. And from that time forward, it has been the way the laws have been written is that they have tax favored status, and as long as a person has their money growing inside of the life insurance protection or that electric fence, it can accumulate tax deferred, and it can be accessed income tax free if it's done properly. So that was a very cool thing that got in place, but this is why it's that way. And a lot of times people are like, well, I've never heard of this before. I didn't know money could be in life insurance and it could be tax defer or tax free, and I could access to it tax free. But this is why. And what happens is that since this time, this law has never really even been threatened because Congress has a ton of their money on the individual basis in these policies. Banks have ton of money in these policies, but this is where that came from. And I want you to be aware of that and why it's that way. Okay. So if you fast forward, then, that was the main product. But along about 1980, the baby boomers started coming of age. And at the same time, a guy named Art Williams was introduced to a concept that he became known as buy term and invest the difference. And what happened was his father died and his family was dramatically underinsured. He found out during this time, and the baby boomers, as they got older, they asked lots of questions. They did things different than they had been done in the past. And so what happened was that, Art Williams' father died, and he had, and I don't remember the amount, but he had around $30,000 of life insurance. And it was a whole life policy. And his cousin, who was an accountant, had found out about term insurance and said, "Did you know that for the same premium, your mother could have received $250,000 or more of life insurance?" And he's like, "There's no way that could be true." He says, and he researched it, and he realized it was, and he became very evangelical with the story and told everyone around him. And that's where the genesis of Primerica came from. Is that he wanted to take that story to everyone, and of course, he didn't know how to go build distribution. He meets Hubert Humphrey, and that's where everything becomes the explosion because Dad built distribution. But with buy term and invest the difference, what happened was it was basically a two-check system, which means instead of you writing one check for your insurance and your savings, you wrote two checks. You wrote one check over to your life insurance company, and that was to buy you a term policy. And that was, let's just say you're spending 200 a month, and now $30 of that thereabouts went over and bought you that coverage. And then you took the $170 yourself and invested it into the market, whatever product you thought was the best place for you. And so you wrote a check for the insurance, and you wrote a check over for your savings. Now that was one of the great concepts of all time. But what happened is it became a flawed concept because human nature was such that people bought term and spent the difference. Only about 15% of the people that ever bought term insurance invested the difference. And out of all the people who ever bought term insurance, less than 5% of them ever paid off. So the theory just did not work. But what happened was it was a concept of where people took control of their own situation to where they wanted to do this. Well, human nature was what didn't work because people didn't save the difference. So fast forward a little bit. Imagine the frustration. You know, most of you have heard of a Reese's cup, right? Well, Reese's cup is probably the best candy of all time if you like peanut butter and chocolate. But with the original ad, you had one person that was walking down the street with chocolate, and somebody's walking down the street with peanut butter, and they bumped into each other. And the guy says, "Hey, you just got chocolate on my peanut butter." And the peanut butter guy says, "No, you got peanut butter chocolate on my peanut butter." And so what happened was it became a hybrid, if you will, right? It's a hybrid candy. Well, imagine that an insurance guy was sitting at a bar and that he met a mutual fund guy, and they got to talking. And the insurance guy goes, "You know what? We have the greatest tax laws in the world that literally you could put money in my product. It's lawsuit proof. It's a phenomenal product, and you never pay taxes on the growth. But the downside is the rate of return is terrible." The mutual fund guy goes, "Well, that's crazy because our rate of return is phenomenal. We do great, but our tax laws are terrible." And the guys got together, and some smart person says, "Let's combine those two. What if you could take the tax laws of insurance and take the investment potential of the market? That would become the best products ever." And there evolved what was called VUL. It's called Variable Universal Life. And what happened with Variable Universal Life was it was structured like a life insurance product. Why? Because you wanted the tax advantages that come with that. And so if a person put in $200 a month here, let's just say $30 within it would go over and buy him a policy within this. It was a protection to cover his family. The rest, and just to say $170 would go over, and then it would still be inside of the electric fence inside of an insurance policy because you wanted that to protect you from taxation. But within this, you could choose which mutual funds it went into. And in this case, the product we sold was Janus Capital, which was one of the best products in the world, and it was phenomenal. You had the best of both worlds. You had the cheap insurance. You were forced because you put in the premium and you had to get both. You couldn't get one or the other. And you had money growing in the market. And it was incredible. And I'm talking 20+% good for 10 years. Well, why doesn't everybody in the world have VUL today? Because the rate of return was incredible during that decade, but it proceeded to do -20 and -30 because it was tied to the market. Well, the next evolution of this product came with what we know of as today. And the IUL has been around a minute, but it wasn't the sexiest thing because people were all excited. If people could get 20% rate of return and never pay taxes on it, it's the greatest thing in the world, right? Well, IUL is the best of all worlds. It's still technically an insurance contract because the savings account, it's got all the taxation privileges that come with it being called life insurance. And then on the other side, you have, it's got the forced savings where you have to put one check, you pay one check. So in this case, theoretically, if a person's spending $200 a month on this example, $130 or whatever would go over and buy them the insurance they needed. The rest, the 170, now would be going over into the cash value, but now it's tied to an index, an index that you can pick, but that index has what? It has a floor. So now in today's world, you're guaranteed that you cannot lose money. Zero's your hero, right? Everybody wants that because you cannot lose money. So now you can have the upside of the market, but you're protected against the downside. And then they also solved one of the big issues, which was, well, nobody, one of the ways that the buy term invested difference guys go over and kind of talk about why it's still the way to go. They'll say the only way you can access this money and have it be in a tax favored status is to take it out in the form of a loan. With whole life, in the old days, you would get 1 or 2% rate of return on your money, but the only way to get it out was through a loan. So imagine you went to a bank and they gave you 1%, but they told you had to pay 5% to get your own money out. You'd tell them they were crazy and you'd leave that bank and never go back. Well, that's kind of the way whole life was. But now you're able to go in and take your money out with what's called a wash loan, where you're almost paying a 0% return or 0% interest on that loan. Why do you want it to be a loan? Because the loan protects you by giving you a tax favored status. So that's how we got to today, guys. It's a hybrid product. It's the greatest product of all time. And what happens now is that you're able to go and to be able to you're able to go over and to be able to there we go. You're able to go over and to be able to take advantage of all the tax implications and all the great things that go with that, and be able to go have all the great things that go with the market and have the floor. And it is. I want you to understand how incredible that it is. That's how we got here. This is an evolution of an evolution. And listen, and the whole way through, whatever was the best product, we sold. What was the best product in the 80s? By term invested difference, we sold more of that than the world has ever seen. What was the best product in the 90s? VUL. We sold more of that than anyone else in history. What's the best product now? IUL in most cases, and term insurance, of which we do both. We're still the biggest producers in the world for that. So I think that's an exciting story. I think it's a really cool story. I'm real passionate about it. Hopefully that gave you an idea of why this is how it all came about. And these are brilliant people providing us with phenomenal products that do everything they said they're going to go do, of which we are now the chief distribution force in the history of the world. So, Kimberly, turn it over to you. Any questions on that, by the way?
And if I can add something, Jody, is that most people that are in that company that are still seeing buy term invested difference, they're not really able to go ahead and fulfill that mission, because in order to go ahead and actually sell that product of the difference, they need to be securities licensed. And I've met in the years that I've been in the industry, I've met less than a handful of people that were actually securities licensed in order to fulfill that mission. So it's more of a statement rather than really a mission, if you know that you can't really fulfill the mission, because 90% of the people you're recruiting are never going to be able to go ahead and sell the difference.
Absolutely. And also on top of that, the other reason, and this is being real, the other reason people didn't buy term invested difference because that agent only made money on the term part. And that kind of goes with what Adam said. And I don't care what you say, you're going to sell what you make money on. Yep. You can tell me you're an angel or whatever, but this is a business, and that's just what happened. And so this is exciting, and we have whatever's the best for them. And if you just want to go sell to people who can't save money and just need more coverage, then you knock yourself out and sell term all day long. Of which by the way, we have the best term. It's very important you realize this. Of all those companies, even the one that's the most famous one of buy term invested difference, we have a better term product. It's a better rate. It's as good of a company backing it, and it has better living benefits. So all those things are awesome. I just think that's a way cool story. And I like it sometimes saying it that way, because there's all kinds of ways, because Mauricio shows it in calendar or calculators. Zach does a great job on his brother A, brother B. Sometimes I just think, just a good old fashioned talking to about where it all came from. is a good way to reset kind of where we're at. So hopefully that helped you, and that gives you just a little bit of feedback. Anybody else have a question? Awesome. All right, Kimberly.
Jody, I got a quick question.
Sure.
I got a quick question, Jody. Primerica, term insurance. If I'm not mistaken, they're an insurance company that cuts and underwrites their own insurance. Is that right? They're
Yes,
not
they do.
outsourcing. So
Right.
that's the other competitive advantage. We don't do our own insurance for them. We go through the best of the best world-class carriers.
Right now, and I will tell you that their product doesn't suck. You know what I mean? They're a good company, but it does give you a competitive edge because when you're right, James, where you're able to go out and if you don't separate manufacturing and production, which is what that is, then you're going to always be in a position where other people can move faster and give options, and it's a better look also. Just being able to say, look, we're going to do whatever's the best one. Because I promise you, I mean, I have watched Corebridge and their living benefits and what they have done. I've seen 4 or 5 specific things that have impacted my life. Some of them have impacted Kimberly's family directly, and others I've seen across the board. And they're phenomenal. They're a phenomenal company when it comes to that, and their rates extremely competitive. So yeah, we got the products, we got the concepts. Because I'm going to tell you something, and this is something we kind of get away from because we have so many concepts. But the IUL, whenever we were started as a company, we just built all of HCI was built on living benefits and IULs. That was it, and then we diversified into all this other stuff. But you got to understand something. If somebody wants to put money away and never pay taxes on the growth of that money, if they know how to go use a SEP, then that's great. But even most of us, if you make above $180,000 a year, you can't use one. But it is the best product in the world for someone, and it's the only place to where they're not going to be able to. They don't have to pay taxes on their money, and they get on the growth of their money. But that's why it's because of that electric fence around that. If somebody goes, I hate insurance, you just say, well, do you hate insurance or taxes more? Which one? That is a simple thing. So thanks, guys. Kimberly, turn it over to you.
Hey,
Yeah,
Jody.
awesome.
Yeah, go ahead,
Gail?
Gail.
I just want to add something real quick. We're in the St. Louis area, and Edward Jones is based out of St. Louis. And I've had this conversation with Matt Salvatore multiple times. Just not all life insurance policies are created equal. Not even a Corebridge product sold through Edward Jones includes the living benefits. So I just wanted to let everybody know that in case you're ever in a competing situation, if somebody says they have a life product through Corebridge that their Ed Jones rep wrote on them, it doesn't have those living benefits, and they might want to replace it. In addition, State Farm also no living benefits. So just a heads up, if you are ever looking at replacing somebody's policies, that might be a good argument to have.
Absolutely.
Can I add something as well? Exactly. I think Gail nailed it on the head there, because the reality is that there's a lot of insurance companies out there that just don't offer living benefits. And I mean, as a guy that came licensed from the supplemental health world, where I sold cancer, heart, accident insurance, nothing against those policies, those indemnity plans. But I will say life insurance with living benefits is changing the game and even replacing a lot of those Aflac Colonial Life, Washington National Life policies out there.
Yeah, and this is a perfect segue to Kimberly's part, because she's actually got some things that we're getting educated on. We are always trying to learn, and so these are some things we'll hit you with right now that are newer to us. I mean, not that completely new, but how to use them. And these companies they're coming up with these differentiators to compete with each other. And this is Corebridge has some specific things which she's going to tell you about right now that give them a competitive edge. And so, and let me tell you one last thing is that if any of these product providers get up and always say, hey, like, we're the best and someone else isn't, I got a problem with that. I'll go on record as your leader telling you I got a problem with them saying that. Most of them don't. There's one or two that do kind of come close to saying that. They're all great products. The issue isn't the wrong product. The issue is 90% of the people aren't saving anything. Most of the people we know aren't even insured. So we have wonderful products. They're all great products if they're structured properly. So Kimberly. Thanks.
Yeah, awesome. Thank you. So lots of great nuggets that I want to kind of mention before we go forward. But as far as the conversation Gail said, so a lot of these companies don't have living benefits on the life insurance policy. When you're talking to a client and you ask them about their life insurance, just say, do you have living benefits? Most of the time they're going to say yes, and say, awesome, I'd love to read it. And they will send you the policy and you can read it and say, actually, you don't. Let me show you this. And you'll be able to replace it every single time. I think the comment that Jody made of, okay, fine, do you hate insurance or taxes more, is valid, right? Those are very easy little things that you can say is, okay, you hate life insurance, but would you rather pay for life insurance or taxes? Like, that's a no-brainer. But I would also venture to guess that those of us that have been in this world for a long time, right, for a minute, all know that story that Jody just told like the back of our hand, because it's how we were taught. If I ask Adam, I bet he could do exactly the same thing that Jody just did. If we ask Mauricio, I bet he could do exactly the same thing that Jody just did. If you ask Zach and I, we could do exactly the same thing that Jody just did, which means that you guys need to take this recording on YouTube and you need to go back and watch it, and you need to listen to what he just said to you and define and be able to describe the industry and how it was started and where these products came, so you can write it out on paper. Because when you do, and you have the ability to say, well, let me show you, and you pull that up to a client and you know it like the back of your hand, they're like, oh, wow. And there's no more discussion about it. So don't, I think, Jody, this is in my opinion, I think that's a good blast from the past, but also a reminder of sometimes we just need to go back to the basics and let you guys know where these products came from, where our industry evolved from. Why don't we, I heard a comment the other day from a client and they're like, well, my money's in CDs and it's protected by insurance. And I was like, and then she was like, and I don't want to invest in insurance. And I'm like, well, you just said it was protected by insurance. Like, that was your reason for not doing this. And it makes no sense. Like, who insures the banks? Insurance companies, right? So, but the reason banks have FDIC is because of the stock market crash, and really because of the savings and loans debacle in the 80s and the run on the banks, right? So just know your history and know your stories, because it'll be much easier for you to overcome objections as long as you understand them. So I'm going to share my screen. I asked Matt to put together a presentation for us when we were at in South Carolina, which is where I live, when we were at the retreat last week. And I asked him to send it to me this morning because I think there's some really great sales ideas on here that I want you guys to see. So I'm going to share my screen and we're just going to go through it fairly quickly, because I know we don't have a ton of time today, but I want you guys to see this. So first of all, you guys know that Corebridge is it is a new name, but it's not a new business. Corebridge was AIG, and it's just basically rebranded. They're one of the largest and most established life insurance companies in the world. To me, this is the slide that Jody was talking about. $41.7 billion in premiums and deposits in the last 12 months. Almost 42 billion with a B in the last 12 months came into that company. Crazy. They have $404 billion in assets under management and administration, which means that they have 10 times their claims paying ability in or that they brought in last year under management. They have $51 billion of claims and benefits paid out over the last 5 years, which means that they have paid out almost a little over $10 billion a year. And some of you guys know, like, Jeannie, Zach's aunt, was a recipient of living benefits, right? So we've had several people in our company that talk about their stories and what's paid out. That's part of that $51 billion. If I'm selling you an insurance policy that has living benefits, don't you want to know that that company is paying out living benefits? Absolutely, right? And then finally, what Jody said is they have $1 trillion of life insurance in force, face amount in force as of April 1st, 2025, which is pretty fantastic. Sales updates, you guys know that we're number one for Corebridge. The really cool thing that you can see here is our product mix is pretty much 50-50. We have half our business in term and half our business in the permanent, which is fantastic from a product mix, both in our organization and also for Corebridge specifically. I'm not going to go through their sales numbers because I want to go over these different sales ideas, but a couple of things to note. They've made some illustration enhancements on the IUL. So a lot of times, I know Jade's asked me before, like, what's the, where can I talk about the company financials and what their ratings are? So now they've put this in as a page in the illustration, which is huge. It's amazing. You can pull it up and say, hey, it's right here at your fingertips. You guys have seen the policy highlights where they take your data from inside that policy and they say, hey, here's what happens if you die too soon. Your family gets this death benefit. Hey, this is what happens if if you live too long. This is your cash distribution. This is what happens when you get sick. This is what happens if you decide to surrender your policy early, what your cash value is at these different ages. But they've also put in, and if it isn't in now, it will be in the next little while, a range of how much benefits you can actually get. Because that's always been a big question from clients is, well, how much am I going to get? Well, I don't know. It depends on your diagnosis. It still depends on your diagnosis, but it at least shows them, a chart, like a graph of what the range is of potential accelerated benefit amounts, which I think is awesome. So a couple of things to know. So I get asked all of the time, do you have return of premium term insurance? And we do now through some of the other carriers, but Corebridge does not specifically. So what are our options? What are our choices? Inside, and this is called the enhanced surrender value rider, but inside some of these policies, they've got a return of premium built in. What does that look like? And some of you guys might know this, some of you guys might not have any idea. But ultimately, the enhanced surrender value rider gives you more flexibility, obviously. But how does it work? So first of all, the rider is automatically included in the policy. Once the policy is sufficiently funded, and I think this is for the VP, I can't even speak, the VPP, right? The Value Plus Protector. But once the policy is sufficiently funded, the rider provides 2 opportunities to fully surrender the policy and receive the enhanced cash surrender value. So if the policy is surrendered 60 days prior to the end of policy year 20, the policyholder receives 50% of the premium paid if they wanted to do that. Or alternatively, at the end of policy year 25, they can get 100% of the premiums paid. If you've ever sold return of premium term, you buy that based on if you want 50% of your money back or if you want 100% of your money back, right? And that's more expensive, depends on that. And there are no restrictions on how you use your premium. So this rider is basically the same thing built in for that return of premium. And if that is what someone's concern is, then just give them this policy and sell them this rider. So let's look at the math. This example is a Value Plus Protector with enhanced surrender value rider on this policy. Male, 45, preferred health, currently looking for $500,000 of coverage and is considering purchasing 25-year term to cover his needs. Raj believes term insurance is the right choice because he's interested in affordability, but he also believes IULs are too expensive. So what are our options? What are our solutions for him? If we offer him the Value Plus Protector, it gives him that enhanced surrender value, which offers that guaranteed return of premium, not a question. It is guaranteed to be returned at years 20 and 25. So giving the client option that at the end of year 25, he can exercise that return of premium or continue coverage. I don't know how many of you guys have been in the business long enough to talk to clients at the end of their term, but what do they usually say? Can I get more insurance? What's it going to cost me? Right? So the reality of them actually wanting to exercise that return of premium, in my opinion, is very low, but they still have the option. So what does that look like? We can sell them that 25-year term, right? We can say $500,000 25-year term coverage is going to cost you $1,020 a year. At age 70, they would have paid a total of $25,500 into the policy, right, for that death benefit, and they have no remaining insurance. Or we could offer option number 2, and that gives them a term alternative. So it's the Value Plus Protector. It's going to cost $3,520 annually, which is obviously, $2,500 more per year. But age 70, he's got a cumulative total premiums of $87,996 on a guaranteed basis, not a question. On a guaranteed basis, he can exercise that return of premium and receive 100%, because that's after 25 years, right? 100% of that money that he's paid in back to him. Or, depending on index performance, the cash value may be higher. Based on this rate of return that he ran, he could have just pulled $98,000 out of the policy. So if you're going to collapse it either way, instead of getting the return of premium, just take the cash value if it's higher. But ultimately, it gives him choices, right? It gives him options. So number one, keep the coverage in force. We don't know what's going to happen in 25 years. We have no idea if we're still going to want life insurance or not, right? So that now they have an option, because it's a permanent policy. It can stay there forever. So they can keep that coverage. They can cash out that coverage with a cash surrender value, or they can exercise their return of premium, but it gives them all of those options. And obviously $87,000, $88,000 is more than 25. So I'd rather have all that back than just wasting $25,000. So what option makes the most sense in this example? So we've got male age 45, preferred non-tobacco, 500,000, QOL flex term. The premiums, he'd be paying $85 a month for that 25-year period of time, total of $25,500 paid in. Projected accumulation at age 70 is zero, because cash value or term insurance has no cash value. And death benefit, living benefits at age 85 is zero, because the policy is gone, right? At age 70, the policy is over. Or we could do this value plus protector with lifetime pay, meaning they pay for the policy forever, right? They're not going to pay it up in a shorter period of time. They're just going to pay those premiums for the rest of their life. It's $293 a month, or $3,500 a year. A cumulative premium over 25 years is $87,996. That if they don't want life insurance anymore at that point in time, they can get $88,000 back in their pocket, which is a really, really big deal. Their projected accumulation is $95,618. So really, they would take the cash value, not the return of premium, because it's more. And if they kept the policy in force, the death benefit and living benefits at age 85 is $500,000. It gives them options. It gives them choices. And if they want to not have to pay it forever, because it's a permanent policy, we can play with that, right? We can structure it for a 25 pay. All right, my term was going to be done in 25 years. I want this done in 25 years. At age 70, I don't want to pay any more into this policy ever. Okay, great. So we're going to pay a little bit more. We're going to pay $350 a month, which is $4,200 a year. It means I've paid $105,000 into my policy. Same return of premium guaranteed, no questions, no index performance, nothing. At age 70, I can withdraw $105,000 and collapse my policy if I choose to do so, or I could just pull out the projected cash value if it's more. And in this example, it would have been $132,000. And if I keep the policy, I still have $500,000 at the end of the day. This is a story we need to tell, especially as we're selling term policies for people that, are not 20, right? As they get older, how long do you want this life insurance policy? Would you want to pay a little more? Maybe we still do the, term for the big piece of it, but maybe we put $500,000 or $1 million of this permanent policy out there forever. Maybe we do that. But giving your clients options, if you break it out like this and you show them this, at least it gives them something to think about. At least they have the ability to say, oh, that makes sense. I actually would rather do that, because I'd rather have that return. And guess what? Instead of being paid on $1,000, you're paid on $3,500 or $4,200. And it's still great for the client as well. Gail, did you have a question?
I was just going to add something. I just set this up, one of these on a client of mine who she's had long-term care insurance since 2012, and every year her costs have either gone up or her benefit has been slashed, or both. This year alone, her long-term care insurance went through a 77% increase. So we ended up, instead, we're replacing it with Corebridge's Value Plus Protector, IUL, with the lifetime pay. and now it's fixed moving forward for the exact same benefit as what she would be getting this year without reducing her benefits and not having to worry about what happens next year. So it's a great solution for long-term care. She's 65 years old, just so you know.
And we're going to talk about that rider in just a minute, which is the AAS rider, which is the Accelerated Access Solution rider that Gail's talking about. But yes, it is a great example for long-term care. But this is just return of premium, right? This example here is just, okay, I'm competing with return of premium term. It's going to be more expensive than that flex term anyway. So give them this option and let that cash value grow and let them have the option of not having that term expire if they choose to
Hey,
do so.
Kimberly.
Yeah.
The other thing I just remember from the other day was the reason that we got into this heavy was that somebody asked, I think the longest term we have right now is what, 30 years? Is that
I
right?
think 35, but yeah.
Right. And then somebody actually asked, hey, can
Oh,
we get a
yeah.
40-year term?
Yeah.
That's what caused this whole conversation. And finally, real sharp guy got up and he goes, he didn't say that's ridiculous, but he said
But he kind of
that
did.
he said that's called permanent life insurance. And then he
Right.
showed this example.
Yeah.
So if you have someone looking at a real long term,
Just know the
that's what this
stories,
is. Yeah,
right? If you
right.
give your clients options, and that's what I tell them all the time, my job is to teach you your choices and to educate you on your options. It's your job to choose. I don't care which one they choose. I just want to make sure that I presented it accurately and gave them the information to make that proper decision. It's always going to depend on the client's goals and objectives, but obviously the client should be aware of all options. So I'm going to go through these just really, really quickly because I know we only have 5 minutes left, but we also have the Imperial Plus. If you guys don't know, this is a proprietary product to HGI created by us and Corebridge in unison. We went back and forth and said, this is what we want on this product. And it is one of the best in the industry. So it's improved on their QOL Max Accumulator, which is the other product out there. And we have some added riders as a result of that partnership and conversation. The first thing that we have is the Income for Life rider, which I think is huge. And some of you guys might understand this and some of you might not. But when we run those distributions on our IUL illustrations, and I say I want income from 65 to 90, that is not guaranteed, right? We can project it. We can say if this returns this way, but there are all these ifs, ands, and buts about it. And that gives us a good general idea. But when it says Income for Life rider, it is guaranteed, zero question, every single time this money is going to come into you, regardless of market performance, how much we have in there, any of that, when you turn this rider on, which I think is huge to understand. It's also automatically included in all of our Imperial products. It's not something that you have to add later. There is inside that little distribution box, there is a box where you can say, illustrate Income for Life. And just to spoiler alert, that Income for Life guarantee is going to be less than what you're showing on those distributions, because obviously it's guaranteed and it's for the rest of their life based on those projections at that point in time. But that is there. I have also asked them, on that front page where it shows all the perks of the policy, if this is built in every single time, instead of making me choose between showing distributions or Income for Life, put the Income for Life on there as a living benefit, because it is, right? What would it pay me if I turned it on for life? And then you can still illustrate your distributions to show them the difference between choose this rider or choose to pull it out this way. It's up to you. But that's huge. It's a really, really big deal to understand. We could go into lots of big conversations about it, but again, I'm going to go quickly for a minute, and then we can continue this conversation later. At retirement, what is more important to a client? Is it how much money they have? Is it their assets, or is it their income? What do you think? Hands down, zero question, it's their income. It doesn't matter if they have $5 million in the bank. It matters how much they can pull from that $5 million and make sure that they aren't outliving their income. It's that Tom Hegna paychecks and paychecks conversations, right? So retirees are wired not to touch their nest eggs because they've been growing them for so long. We have to figure out how to turn that into income, and we've just shown you how to do that guaranteed in this policy, which is huge. Again, I'm not going to go through this one right now. I just wanted you guys to know that, but there is that income for life rider on here as well. This rider is the accelerated access solution chronic illness rider that Gail was talking about. So I don't think we have to, have a conversation about how many people are going to have a chronic illness. The odds say 60% of Americans are going to have chronic illness. Most people have Medicare, or don't most people have Medicare is a big question people ask. And they say to pay for something like this by the time it happens, beyond 100 days, Medicare pays zero for long-term care services. What you going to do then, right? It is not covered. And then if you become chronically ill, will you have the ability to choose what kind of treatment you want? Do you really want to have to go to a nursing home, or would you rather have the ability to pay somebody to come into your home? Do you want to, let's say you had a stroke and now you're in a wheelchair for the rest of your life. Do you have the money to put a ramp on the front of your house to make it accessible? Probably not. Most long-term care policies do not pay for things like that. And anything that you pay for with a long-term care policy, you have to pay it out of pocket, have a receipt, and submit it to be reimbursed. With this accelerated access solution rider, if you need it, it is if you qualify for it, I guess, like your living benefits, then it's automatically going to give you that without receipts, without reimbursements, any of that. So you've got money to make a decision on whatever you want to do with it. This is just an example, and Matt says if you go to, I think it's Genworth, that shows you what long-term care costs per state, but this is in Atlanta. So if you had someone, home health, come into your house, you're paying about $62,000, $63,000 a year. Adult daycare is $28,000, assisted living is $63,000. If I'm in a nursing home, a semi-private room, and I don't want to live with anybody if I'm in a nursing home, right? Like I've lived my life this entire time. Now just I want to have my own space. $113,000 to $122,000 a year. That is crazy. People cannot afford this. So why not add this accelerated access solution rider on any permanent policy you write through Corebridge, and at least give them the ability to distribute that death benefit as a long-term care policy, which again is what Gail was talking about. And long-term care continues to go up every single year. These policies don't. When we underwrite it today, whatever we lock it in at is locked in, guaranteed until the policy is either paid up or if you pay it forever or whatever it looks like. 2044, obviously, this is projected out on what it's going to be, which is going to be crazy. Can you afford a diagnosis? Can you afford long-term care? Do you have that money? And why would you? Why would you not just allow insurance to do that for you? So again, some of the things that it talks about that it covers, and it's not that it covers, because if you qualify for this money, I don't care if you take a trip around the world, you got the money, right? But adult daycare, assisted living, massage therapy, prescription drugs, what about just somebody come cut your yard, right? Long-term care is not covering that. But this gives you the money that you can choose what you want to do with it. Gas for back and forth to treatments and transportation, cash in your pocket. If someone's in your home caring for you, they're probably taking time out of their life. Would it not be nice to be able to supplement their income for them helping you? Yes, absolutely. So it just sets you apart, and it gives you a few extra things to help them with. So this just gives you a hypothetical example on the top right. If I have a $250,000 index universal life policy that I purchase 100% of that as an accelerated access solution, what that means is I can either get, and I determine this when I purchase a policy, I can get 2%, 4%, or IRS per diem as my payout if I qualify. So if I have $250,000 at a 2%, I'm going to get $5,000 a month, which means that $250,000 is going to last me for 4 years and 2 months. If I'm at 4%, I'm going to get $10,000 a month. So it's going to last me less because I'm going to use it faster, right? 2 years and 1 month. And then IRS per diem is obviously variable based on what the IRS rates are that time. But right now it's right at 21,000. So it's going to last for a year. But it gives you this money. So in this example, you either die and your family gets the death benefit, you live and you have an assisted living issue and you can pull it out and access it as an accelerated solution, you've got living benefits, or you have the return of premium and the cash value that we've already talked about on this policy. To me, it's a no-brainer, and it checks a lot of your boxes. And it's definitely a long-term care at least competitor, but it also gives you long-term care coordination services, which means that it locates caregivers for you, develops your plan of care, all of that kind of stuff if you need that. Like, it's going to compare facilities around you, which is huge. It's a big deal. This isn't something that normal people know how to do. So instead of having to get another degree in, long-term care and aging services, this coordination company will take care of it for you. So I'm going to stop my share. I know we're a couple of minutes over, so thanks for hanging out with me to finish that through. But just remember that you have access to all of these things, and they're created for you. And a lot of, like, the Imperials created by us, so use it. And again, this is recorded to YouTube, so if you have questions, go back, watch it again. Call Matt, send them some business, because I think they're great and fantastic and are big supporters of ours. And again, like Jody said, we're their number one writer of all business, like by far. So you have white glove service from all these guys. Before we hang up, any other questions for anybody today? All right. Well, happy Wednesday, and thanks for joining. See you soon.
Great training, Kimberly and Jody.